All right, let's just get right into it. Every January, a certain tax form probably hits your inbox, and odds are you completely ignore it. But what if I told you that taking literally 4 minutes to enter one little number from that form could put up to $550 back in your pocket? Well, today, we are unlocking that cheat code. Look at this number, $43.2 million. That's how many Americans with student debt get this exact form. And if you're one of them, then this is for you. You're part of this huge group, and I'm telling you, so many of you are just leaving free money on the table. So the form is called the 1098E. It's just a record from your loan company that says, hey, this is how much interest you paid last year. It looks really boring, it's covered in tax jargon, and that's probably why most of us just, file it away or forget it even exists. And that is a huge mistake. Let's just be super direct here. If you're in the 22% tax bracket and you've paid enough interest, this one little form can literally mean a $550 tax savings. So the question is really, really simple. Why on earth are you skipping it? Okay, so the reason this is so powerful is because it's what's called an above-the-line deduction. Now, I know that sounds like some secret tax nerd language, but it's actually the key that makes this whole thing work. You have to think of it like a cheat code that lets you just bypass the normal rules of the tax game. So to get the cheat code, first you have to understand the main game board, which is the standard deduction. This is the default amount that almost everybody gets to subtract from their income, no questions asked. For single folks, it's around $15,000, and because that number is so big, something like 90% of all taxpayers just take it. And this is where it gets really interesting. See, most deductions, like your mortgage interest or donations to charity, they live below the line. You can only use them if you give up that big standard deduction, which for most people, that's a terrible deal. But student loan interest, it lives above the line. It literally jumps over the barrier. And that's the whole point. You get to take your big, juicy $15,000 standard deduction, and you also get to deduct your student loan interest right on top of it. You claim both. That's why it's a cheat code. It's this special little exception that's basically built for the 90% of us who don't bother with itemizing. All right. There's always a catch, right? And in this case, it's the income limits. But here's the good news. It's not a hard cliff you fall off of. It's what's called a phase-out zone, which means even if you're in it, you can probably still claim a pretty nice piece of this deduction. So here are the numbers for all the single filers out there. If you make less than 75 grand, you get the whole thing, full deduction. If you're between 75 and 90,000, you're in that phase-out zone where your deduction gets a little smaller. And if you're over 90,000, sorry, it's gone. Let's see how that shrinking part actually works. To make this crystal clear, let's just walk through a real-world example. Everyone, meet Tyler. He's a marketing manager, and trust me, his situation is super, super common. So, Tyler's single. He makes $81,600, and he paid over $2,800 in student loan interest. Now, you can see his income is right smack in the middle of that phase-out zone we just talked about. So, does that mean he gets nothing? No way, absolutely not. Okay, let's break it down. That phase-out zone, from $75,000 to $90,000, is $15,000 wide. Tyler's income is $6,600 into that zone. So if you do the quick math, that means he's about 44% of the way through the zone. And that percentage, that is the magic number we need. So because he's 44% through the zone, his maximum possible deduction, which is $2,500, gets reduced by that same 44%. That's a reduction of $1,100. So his final allowable deduction is $1,400. And that $1,400 deduction in his 22% tax bracket turns into $308 of actual tax savings. Cold hard cash. Sure, it's not the full $550, but it's $300 he would have totally left on the table just because he assumed he made too much. That's real money. Now let's switch gears and talk about another thing that trips a lot of people up. With these new repayment plans like Save, a lot of you are asking a really smart question about how this deduction works. Yeah, the SAFE plan is awesome because the government often steps in and covers your unpaid interest so your loan balance doesn't explode. But that creates a tax puzzle, right? Can you actually deduct interest that the government essentially paid for you? And the answer, as you can see, is a simple no. The rule is crystal clear. You can only deduct the interest that you personally paid with money from your own pocket. Any interest that was subsidized by the government, that doesn't count.
But, and this is the best part, you don't have to do any of this complicated math yourself. Your loan servicer figures it all out for you. The exact number you need, the amount of interest you actually paid, is sitting right there in box 1 of your 1098E. Just use that number. It's that easy.
Okay, so now you know why this works and who it works for. Now for the super easy part. Here's exactly how to claim this deduction in, I don't know, about 4 minutes. Seriously, it's just 4 steps. 1, grab your 1098E forms. You might have more than one, by the way, if your loans got moved around. 2, find the student loan interest section in whatever tax software you're using. 3, type in the total from box 1. And 4, well, there is no 4. That's it. The software does all that tricky phase-out math for you. And to make it even faster, here's exactly where to click in the most popular programs. For TurboTax, you're going to go to Deductions and Credits, then Education. For H&R Block, it's under Income, then Adjustments. And yep, even the totally free software like Free Tax USA supports this. There's really no excuse not to do this. So we come all the way back to this. A lot of people might think, is a few $100 really worth the effort? But that's just the wrong way to think about it. This isn't like finding a winning lottery ticket. This is your money that you are actively choosing not to claim. The real question is, why would you just leave it sitting there on the table? Look, this takes less time than it does to make a pot of coffee. The form is probably sitting in your email right now. The money is waiting for you. So what are you waiting for?